Ever wonder why a brand new phone costs a fortune, but just a year later it's half the price? Or how some things, like your morning coffee, never seem to go on sale? Well, the answers are all tied up in two super powerful economic ideas: demand and elasticity. So today, let's dive in and decode the hidden rules that pretty much shape every single purchase you make. You know, for any business out there, whether it's a tiny local cafe or a massive tech company, everything, and I mean everything, comes down to answering one huge billion-dollar question. Are people actually going to buy the thing we're trying to sell? Figuring that out, that's the whole ballgame. And this quote, it just nails the problem perfectly. Let's imagine for a second you're running marketing at this company, Aroma Tea. Your CEO comes to you and basically asks you to bet the company's future on a new kind of tea. You can't just flip a coin, right? You need to actually understand the fundamentals of why people buy things. You need to understand demand. So yeah, this is way bigger than just tea. It's about everything we buy. How in the world do companies seem to know what we want, and maybe more importantly, what we're willing to pay for it? It's not like they have a crystal ball. What they have is economics. Okay, so to even start making those kinds of predictions, we have to begin with the bedrock of it all. It's a really simple foundational rule that explains a huge chunk of our behavior as shoppers. And here it is, the law of demand. And honestly, it's something you already know deep down. When something gets more expensive, we tend to buy less of it. When it gets cheaper, we buy more. It's that simple inverse relationship. Price goes up, the amount people want to buy goes down, and vice versa. This table, it's called a demand schedule, really brings this to life. Just look at the numbers for ice cream. When a cup costs 60 rupees, nobody's buying. It's too expensive. But drop that price all the way down to 10 rupees and bam, we're selling 10 cups a week. You can see the law of demand playing out right there in the data. Now let's see what this looks like visually. So this chart, the demand curve, is really just a picture of that table we just saw. See how it slopes downward? As the price drops, the quantity people want to buy goes up. That downward slope is basically the signature look of the law of demand.
But hold on a second. It's not always just about price. Sometimes the entire situation changes for reasons that have absolutely nothing to do with the price tag on the item. The whole game can shift.
And this is a really, really important difference to get. A movement along the curve is just what we've been talking about. The price changes, so we move from one point to another on the same curve. But a shift of the curve, that's a whole different animal. That's when the entire curve literally moves to the left or to the right. It means that at every single price, people now want to buy more or less than they did before. So what kind of things can cause the whole game to change like that? Well, think about your own income. If you get a nice raise, you might start buying more of the fancy stuff, right? That's a shift. Or what if a new health study comes out saying green tea is amazing for you? Suddenly, everyone wants it. That change in our tastes would shift the entire demand curve for aroma tea to the right, even if the price of the tea didn't change one bit. So knowing that demand can change is one thing. But for a business like Aroma Tea, the real money, the real strategy is in knowing how much it's going to change. And this is where we crack open demand's secret code: elasticity. Because see, for a company, it's just not enough to know that things are going to change. The million-dollar question is, how much? How sensitive are your customers, really? If you drop the price by 10%, will you get a few more sales? Or will a flood of new customers rush in? Answering that question is everything. And the tool for measuring that is called price elasticity of demand. It's basically a score that tells us exactly how sensitive we, the buyers, are to a price change for any given product. It puts a number on our reaction. Okay, let's break this down. It's pretty straightforward. If a product is inelastic, like, say, salt, it means even a big price change won't really affect how much people buy. We kind of need it, so we just pay. But if a product is elastic, think of one specific brand of headphones. Even a small price change can cause a huge swing in demand, mostly because there are so many other options to choose from. Now, this might sound a little academic, but I promise you, understanding elasticity is one of the most practical and powerful tools a business can have. Why? Because it directly tells you what a price change will do to your bottom line. And this is where things get really interesting. For an inelastic product like essential medicine, a company can actually raise the price and their total revenue will go up because almost everyone still has to buy it. But try doing that with an elastic product, like a can of soda. If you raise the price, your revenue is going to tank because everyone will just switch to another brand. At the end of the day, elasticity is what determines your power to set prices.
And that brings us all the way back to our CEO at Aroma Tea. His big billion-dollar question isn't just, will people buy our green tea? It's, how will they react if we mess with the price? Is this green tea a daily must-have that people can't live without? Or is it a special treat they'll happily skip if the price ticks up? Their entire strategy depends on the answer.
So here's the thought I want to leave you with. Economics isn't just about boring charts in a textbook. It's a way of seeing the world around you. So the next time you see a giant 50% off sign in a store window, don't just see a discount. See it for what it is, a calculated bet. That company is betting that their product is super elastic, that the tidal wave of new customers they'll get from that price drop will more than make up for the lower profit on each sale. They're using these exact principles to predict and to influence what you're going to do next.